Really excited to be here today and more excited to have the panelists that are here today with us to talk about what is really an exciting subject. Hello, everybody. My name is Phil Goldfeder. I am the CEO of the American Fintech Council. The American Fintech Council is a standards-based trade association, the largest fintech trade association advocating for responsible innovators in fintech and financial services. And I think real key differentiator is that we represent all sides of the ecosystem and every company in between. And so innovative banks, fintech companies of all sizes and kinds, and really excited, most importantly, to think about how do we build out regulatory infrastructure for emerging industries and financial services. I've joked with the panelists that are here today. I don't often get the opportunity to present on AFC's webinars. I know that I'm the CEO of the organization, but I've only learned more recently how little that means in terms of the decisions I get to make. My team is in charge and they don't let me do these often. But when I saw the panelists that we had and I saw the topic, this was one that I was absolutely not going to miss. And so really excited to be here and maybe just take a very quick minute to let our panelists introduce themselves before we jump into the subject matter of the day, which is chartering and the steps after chartering and all the challenges and exciting things that really are the follow up to getting out of the gate. And so with that, just maybe as a quick round of introductions before Juan, maybe before we actually get into the substance, why don't you just tell everybody who you are?
Hi, everyone. Thank you for joining the webinar. My name is Juan Azal. I chair the FinTech Banking and Payments Group at Winston Taylor. I know many of you. And obviously, we do a lot of speaking arrangements at the Great Summit this year, not withstanding. Carl?
Yes, good morning for those on the West Coast and good afternoon elsewhere. I'm Carl Fernandez. I chair the Financial Innovation and Regulation practice at Winston, and I am Juan Azal's partner.
Janet?
Sure. Nice to meet you all. I'm a senior managing director with FTI Consulting. I co-lead our consumer financial services practice. Prior to consulting, I led consumer compliance at KeyBank, and I started my career as an examiner with the OCC. Nice to be here.
Amazing. Thank you so much for being here. Casey?
Hi, everybody. Casey Seifert. I currently serve as Deputy General Counsel for Mercury, covering our product and regulatory counsel team. So the lawyers that are embedded with the PMs and the engineers. I wear a second hat as one of the organizers of Mercury's proposed national bank and as the proposed general counsel for that entity. So deep in the process that we're talking about today. I started my career at the FDIC, actually working on a bunch of different things, including deposit insurance applications and have a mixture of traditional banking and fintech background. So excited to chat with you guys today. Thanks for having us, Phil.
Yeah, no, my pleasure, Casey. I've had the opportunity to hear different members of the Mercury team speak about this process, and I tell you all the time. I use you as the example of the way in which you're thinking about your chartering application and your chartering process, but most importantly, in the way in which you intend to operate and how you're thinking about sort of the importance of what you're doing and what it means for the integrity of the financial ecosystem. And so tremendous credit to you and to the entire team over at Mercury. And thank you, obviously, to the Winston Taylor and FTI for being here as well and for getting us started. And so you read the news, if you're following fintech, if you're following financial services, the latest and greatest is chartering, various types of chartering, but chartering and becoming a bank and engaging in the banking space. I think what we really wanted to explore today, what I just talked about in terms of the way that Mercury is perceiving and operating as they think about their next step into this world, they're doing it the right way. I think, we hope that others are thinking about it the same way, but we wanted to provide some insights into what that looked like. And that's really what brings us here today, beyond the charter, right? Once you've got it, or once you're deep into the process, how do you manage risk? How do you manage growth? How do you think about operations? And how do you think about actually being a bank? And so with that, Juan, Carl, maybe why don't you guys sort of lay it out for us in terms of what that looks like and maybe get us started.
Yeah. Thank you, Phil. I counted back in March, 35 pending charter applications. I'm sure there's more now. National bank charters, national trust charters, ILCs, everything. So we wanted to put this together, as Phil mentioned. Particularly, many of us have worked for banks or represent banks or work like me in-house at banks. You deal with a lot of fintech companies that have some understanding as to what being a bank is. But there's a lot, I think there's a big difference between actually understanding it from the perspective of fintech and you're actually having a charter, as Casey will probably tell you, huge golf, right? So we're going to go touch about a few things here today, more focused on what happens after, kind of like, okay, finally, I got this approval. Now what, right? Those critical first 3 years, capital planning and management, the ever important risk management frameworks, and then some others, and we'll end up with bank fintech partnerships. And why that? Because a lot of the rationale, right? Why I think we had a lot of fintechs becoming banks is because they want to either become right a bank fintech or enter into bank fintech partnerships or actually have an affiliate that will be their fintech partner. And as we will find out, third-party risk management applies to even your affiliates, if you can imagine that. So anyway, back to you, Phil, or let's Carly. I don't know if there's anything else you wanted to add on this.
No, nothing additional except that it's a very exciting time to be, getting back into the de novo bank charter game, and with a variety of different types of business models that we're going to be hearing about.
Yeah, it's really, really exciting. And again, thank you both. Again, I'm, and I warned my panelists that sort of we're gonna jump around and try and make this as conversation as possible, but also make sure that it's informative. I would just ask, in Casey, sort of everything that Carl and Juan said, and I'm going to start with you. Like, you guys have been in this, you've been through this, right? I think you have recognized from day one what you were doing. Do you like how many people do you, and you talk about your colleagues, like, do you think that most people are thinking about it the way you're thinking about it, or do you think that people recognize sort of what they're stepping into? Do you think most people don't necessarily appreciate sort of the level of engagement and the level of time, energy this is going to take?
Well, it's hard to appreciate the level of engagement, time, and energy it's going to take until you're in it, especially given that we're in a supervisory and regulatory environment that just looks really differently than it used to. There's a tremendous commitment from all three of the federal banking agencies or the FBAs to move in a way that is more transparent and more efficient than what has happened in the past. And we spent a very long time with a bit of a kind of freeze on whether charters would be granted or even considered, and a lot of opacity really in the process overall. And so, I've joked before that like the hardest part of this is helping people understand that it's not easy, and I think that joke still stands. I also think that you've got just a kind of variety in the types of organizations that are seeking charters and why they're doing it. And so one of the things I would suggest to folks on this call and that might watch this on recording, that if your organization is thinking about getting into this, you should spend a lot of time really understanding your why behind it. The window being open, as folks are calling it, alone, like should not be your primary motivator. If it is, you're probably losing sight of the fact that regulatory pendulums swing and like it might come back and hit you. And so I would say, just kind of adapting that tech mindset of first principles and really understanding why it is that you want to go down this route is something that can really help drive focus throughout the process. And, whether that's customer dependence or, customer experience, whether it's, kind of shifting your partner dependence or otherwise, or building on a business model that's already been successful, I would just make sure you know what your why is. The regulators will pick up on whether you have an appreciation of that too. And I think that's particularly important when you're trying to kind of cut through a very, very packed roster of folks who are trying to go down this path right now.
I love that. Again, I continue to just be in awe in terms of how you guys are thinking about it and how you're approaching it. So let's pretend, right? We're gonna pretend that the whole beginning part didn't exist. Casey, I know this has been a big part of your life, but we're gonna pretend this part didn't exist. We're gonna now go into your charter is granted, right? Like you are actually now you have to sort of start, not to start thinking, but you have to continuously now think about, okay, so how you can operationalize. Janet, I'm gonna start with you. I guess sort of help me with that transition, right? Do you think that when clients of FTIs and clients of yours come through the front door, sort of asking for help, asking for guidance, and then sort of that transition into, okay, now you've been granted your charter. Talk to me about sort of the level of preparedness and the level of engagement sort of from pre into post and kind of what that delta maybe looks like.
It's pretty significant, and I'm not sure that there's an appreciation for that evolution. So I think the most important part is truly looking at who are the individuals that are involved with the build of the institution, right? I mean, you can't go back and have the same team that's running a fintech overseas implementing a brand new national bank charter in the United States. So really think about who is going to be running the bank, because they are the primary drivers of all the conversations with the regulatory agencies. And that's really your first step, right? So making sure that you have that strong executive management team in place, and then they will drive the rest of the risk framework that's going to be necessary and highly scrutinized.
Thank you for that. Okay, Juan, Carl, and again, you'll excuse me both, as I know that both of you sort of are going to talk about sort of both pieces of this, but and you'll all excuse me as I do the best I can to manage our slide process. But let's now shift, right? I think Janet sort of gave us a good transition immediately post chartering. Why don't you guys talk through sort of what that looks like and what people need to be thinking about?
Happy to.
Oop, you're on mute.
Yep. Sorry about that. Yeah, I'll start and turn it over to Carl. I think, or in almost every instance, the approval, the charter document is going to have conditions. It's really making sure not to drop the ball on those conditions. I mean, that's really your very first step, right? You don't want to get off on the wrong foot in that area. By the time you get an approval, those conditions would have been discussed. There should not be any surprise whatsoever when that occurs. But it's very important to make sure you comply with those conditions. And really, I'm not going to go. We promise we're not going to go through the slides here step by step. We're just going to talk about little things. We can certainly share this slide deck later on. But out of this area too, for me, having been doing this in the regulatory world for a long time, the last bullet point is so critical. If I had a guess, and if I could go back and look at all the consent orders, enforcement actions that have occurred over the past, let's say 30 years, I think far and above you're going to find BSA/AML, the pillar requirements of the BSA/AML program, maybe some consumer, number two, but this is where I see a lot of banks get into trouble right away. So make sure that your BSA/AML program is being implemented right off, really day one. Carl?
Yeah, I would just add here that it isn't just one application. It'll almost always be two applications. So you'll have one with the licensing or chartering authority, and then you'll have one with the FDIC, which will be for federal deposit insurance. There's some exceptions, for example, if you're not taking deposits and you're going to establish a national trust bank, for example, for custodying digital assets. But almost always it'll be two applications, one to the licensing authority and one to the FDIC. So highlighting the third bullet on that slide.
Yeah, and
thank you.
I want to add
please.
one thing, because I think sometimes this is a part that maybe and I would say there's actually a third, depending on how you're going to structure. You'll work with the Federal Reserve, right? So just like to level it on licensing structure, if you're talking about a national bank, you've got your OCC charter application, your FDIC deposit insurance application, got the Federal Reserve for holding company and consolidated enterprise oversight. They've got timelines that, once you submit, they've got 60 days to review. And then once they approve, you have 90 days to consummate your bank holding company. And so there's just so much timing and sequencing. And we talked about this a little bit earlier. Understanding your why is huge, but like program management of this is a massive part. As Carl and Juan have pointed out, like there's no shortage of back and forth with the agencies here. And if you're going down a state route and they're in the place of the OCC for your chartering authority, there's also dynamics you've got to manage between the state, the FDIC, and potentially also the Fed. So a lot of like sequencing in play in all of this. And when you're thinking about those, immediate post-charter obligations, something I think very useful to keep in mind is like, it's not really a secret what you're going to be examined on. The examination handbooks are out there. You can certainly spend time as an organization just kind of butting your program as you have it today up against what's in those handbooks and start understanding that delta. I think there's something really powerful about being able to speak with your regulators with awareness of the gaps you need to close and action plans developed developed for those so that you don't get kind of pushed into a one size fits all box after you have your charter and your deposit insurance. But yeah, it's definitely a complicated, multi-layered process. But the playbooks are out there, and I think the regulators appreciate it a lot when you acknowledge like the information that's open source and at your fingertips that you can self-serve from.
And I'd like to add something to what Casey just stated. If you saw that there was an OCC bulletin that just came out yesterday, so it's an evolving process. I really appreciate the bulletin too, because it gives some pointers, what to submit, what not to submit, what to look for. If you haven't seen it, it's OCC Bulletin 2026-27, just came out June 17th. So I would definitely take a look at that. And I really appreciate the fact that they provided that information, right? They just didn't go out there and put their information and make it public without providing some highlights.
You guys are going to make this easy on me, and I love this. So please do not hesitate. Pipe in, interrupt. That's the idea. We want to make sure that the conversation is flowing, and that we're, our listeners and those who are watching this either today or in the future are getting really the information they need. Juan.
Phil,
Please.
Yeah, Phil, I just wanted to make 2 points real quick. Again, not going to read the slides. This is available. But on the business plan, the first bullet point, adhere to the approved business plan that you submitted, right? Don't go off that business plan without speaking and obtaining the approval. That's a real surefire way to get in trouble within your first 3 years. And then the last slide in this section, Phil, the other thing I was going to say, if you can switch to it.
Oh, yeah.
Corporate governance. Sounds like something innocuous, but there's a lot more of a governance and more importance to follow governance with a chartered institution than there is with a corporation. Obviously the board composition is critical. You should have gone through that during the chartering process, through all of the IBFRs and all of that information. But then actually having regular board meetings, minuting those board meetings, and the committees as well that report to that board. All of this, it behooves us not to say, particularly the lawyers on the call, that this is critical to show that the bank is being operated in a safe and sound manner, which are going to be gauged against from day one.
I hate to go back to you, Casey. And it's funny, we jumped through both slides, and I can go back and forth if you want to talk about specific points. But something that on the last slide, and I'll just jump back. Business plan compliance, right? The idea that what we said we were going to do, we actually going to do, right? And then again, I think on these, literally the business plan compliance and corporate governance at inception are both 2 slides we could spend the entire hour talking about. Casey, business plan compliance. Again, I know that you guys are sort of working through all of this and will hopefully be successful, and you will be successful, and it's going to be fantastic. But how have you thought about that? When you build out a business plan, you want to be as aggressive as possible and sort of sell a very, very big and exciting future. But at the same time, you want to be realistic so you can meet those and manage those expectations. How have you guys thought about that?
Yeah, it's a great question, and it's a really interesting exercise to be at a fintech and ask your executives and your product teams to think about what they want to offer for 3 years and to write it down and commit that to regulators with the understanding that moving off of that plan requires regulatory approval. And so like just that alone is an important place to just level set internally. And we spent a lot of time really thinking about, what is kind of the trigger point for what's in and what's out. And, we have the benefit of running a successful business. We just announced a Series D recently, and, we have 4 years of profitability under us. And so to think about how we manage and project growth in that business plan is really important. To your point, Phil, you want to make sure that you're not over promising, but you also want to make sure you give yourself enough space so that if that success continues, you're not beating those goals. I think in the privately held company context and the fintech context, beating target is great. In the regulatory context, that screams risk and potentially unmanaged risk. And so you need to have growth goals that are realistic and ambitious. That looks different for every organization. And you need to be really clear with your leadership on how you're going to measure those things. And then feeding into that governance piece, you need to have, because you're going to have to submit as part of your business plan application, draft policies that cover things like governance, including credit and interest rate risk and liquidity risk management. And those are going to be new muscles for fintechs, especially if you're privately held and don't have public company standards applying to you. And so I think it's really just making sure that as you're drafting that business plan, one, you have an understanding of the commitment to transparency with the regulators on if you're going to make changes to those things. Two, you're not overly ambitious in your goals so that you don't look like you're going to take on a ridiculous amount of risk. And then three, you understand some of those governance triggers, including how really aggressive growth goals can impact capital requirements that you're going to have to live with as a de novo bank. And we have some slides on that later, just about how onerous those can be, and those are sometimes surprises to folks. So we've really approached it from trying to think about what's realistic, what tracks with customer need. Your business plan has to include information about product market fit. And so if you're just taking a shot in the dark, the regulators are going to question the credibility and likelihood of success in that, and how to kind of judge you against that, which is a bad place to start from.
I love that. Janet, I'm going to come to you for a second. I mean, maybe staying here for a moment, just in terms of like the thought of making changes, right? Inevitably, things are not always going to go as planned, and you're going to have to make adjustments. How have you felt that level of engagement from the regulatory agencies to the applicant, or to the new entrant? How has that gone? What's the best way to think about not just, oh my God, we've made this big mistake, in terms of the level of engagement and how the best ways to engage?
No, sure. I mean, as with the regulators on a regular basis, I mean, communication is key, right? So if you have any risks, if you have any change to your plan that is going to happen, don't institute that change without having a discussion with your regulator, right? I mean, keep them in the loop. And I think that's really important, particularly at this stage. It's often important throughout the life of an organization, but it's difficult to plan what your structure is going to look like when you don't have all the key pieces in place yet, right? So you get this initial plan, they approve it very, very quickly. When you think about historically how long it's taken, now it's 120 days. But do you really have all the knowledge that where you can predict what's going to be happening over the next 3 years during that initial phase? You don't. So I would say regular dialogue with your regulators is key and very important. And don't put it off. If there's a change in the plan that you see coming, that is going to happen, pick up the phone and call your regulator.
Carl, before we move on to kind of like the sort of moving on in the process and the timeline, sort of, again, getting it right from inception. Now, we talked about just a moment ago, and I think Janet sort of rightfully said, sort of communication is key. But inevitably, like, how important it is to sort of think through all of these things from inception, get it right, be thoughtful, and make sure that you're starting off on the right foot.
Though probably the one reason why you want to get it right at inception, well, I think it's really two reasons. One, you want to get an approval as quickly as possible. This is a process during the approval, from the date of application, really from the date of the pre-filing meeting to the date of the charter and turning on the lights. Typically takes a year, sometimes a year and a half, even possibly longer. And so you want to get it right. You want to make it easy for the regulators. When we file applications with bank regulators will tell us, folks, make this easy on us, okay? Don't submit something horribly complicated. But I think the second reason is that once you turn on the lights, especially, and we're going to be talking about year 1, year 2, year 3, you want to have flawless execution. Why? Because you want to get to that first examination, right? Where it might be a targeted exam, or it might be a full safety and soundness, full scope examination. You want to get good grades from the teacher, right? You want to get at least satisfactory or better across the board, so that you can, after year 3, we're going to talk about this, loosen the straps on that first 3-year straitjacket that a typical de novo is put under.
Amazing. Thank you. So let's then move on. And again, like I said, feel free and excuse me on the slide management, doing the best I can. But obviously, for my panelists, don't hesitate to interject in any way, shape, or form. Maybe Juan, did you want to give us a sort of building out the foundation, sort of give us a quick overview?
Yeah, absolutely. I'm going to start a little bit different, Phil. If you can go to slide 13. No need to start with the next slide, Phil. There. No, don't mean to start with a negative, but I think it's important. I think sometimes we learn things more from our mistakes than we do from our successes. So these are some of the common mistakes that happen within the next 3 years, and this is really what I wanted to focus on. Over-aggressive growth, I mean, right at the top of the list. And I would add over aggressive growth. I mean, you could see it there. That is inconsistent with the same level of investment in risk management. Again, almost in every consent order, you see this over and over again, right? Very exciting. Business is going great, and everything investment is being happened. Maybe you're doing acquisitions or whatever, and there's no corresponding investment in risk management. Critical during the first year, as Carl mentioned, before you get out of that penalty box. So it is critical that you do not outpace growth, or that growth doesn't outpace risk management. Um, Same thing when you talk about investment compliance gaps. Again, not reading the slides line by line, but an underinvestment in BSA/AML, fair lending, consumer compliance. We put fair lending here in particular because it has been certainly under the previous administration, not so much under the current administration, but it has always been an area of critical importance in the consumer compliance space. There's obviously other consumer compliance issues, but it's really or areas of where we should be investing in. But certainly BSA/AML in this area is underinvestment in that we've seen as one of the areas of common pitfalls. Lending will be a big part of a lot of your business plans. Concentration risk is critical as well, ensuring that you meet legal lending limits. Your asset quality is strong. Another area that we've seen, result in some, maybe not enforcement actions, but certainly some supervisory findings during the first few years. And then I think finally, at least for me, I think Phil talked a little bit about this, right? I mentioned earlier, don't deviate from your business plan without the approval. But what could also be bad is rigid adherence, right, to the business plan, even though things are changing. Go to your regulators, speak to them about it, discuss what's going on in the market. Most regulators, if not all, want to see the bank succeed. I would say most or all want to see the bank succeed, right? So, and obviously your earnings is an important component of your CAMEL rating if you are a bank subject to that rating. So if you see that things are changing or your business plan needs to be tweaked, don't also be afraid to adapt and speak it with your regulators. Just some pitfalls, Phil.
No,
I
I will say this. You certainly
again.
took us straight to the negative. And I again, but I think it's important. I think people should be relatively scared, right? Like they should know what they're getting into and what the challenges are. Janet, is there of these five, right? Which one would keep you up at night in terms of what scares you?
Well, Phil, you know my background, so you know what I'm going to say, right? Of course, it's compliance. And I think the most important thing is to understand that those compliance controls need to be built from day one. I mean, trying to reverse engineer and overlay some type of compliance control over a system that's already built, it's just too difficult. So this is a great opportunity for these de novo institutions to think about compliance from day one, and the regulators are going to expect that as well, I would say.
Casey, we're bringing you back to the positive, okay? This is obviously, these are things that you have thought of up ways, down ways, sort of your organization in terms of how you build it. Talk about building the foundation across the board in terms of how you think about technology and personnel and the compliance and all these things that you now can have to do.
Yeah, most definitely. If you're a fintech that's operating with mature and wonderful partner banks like we've had the privilege of doing, you have a good foundation point to start from. And so you're not at zero. If you are a true de novo, there are plenty of things to go out there and look to as examples. I think something that has to be kept in mind when you are building this foundation is to just not get too confused by the kind of deregulatory tone that you're hearing in the broader atmosphere, right? When you think about a de novo bank, it's a new institution. So while the regulatory focus right now for mature and existing institutions is really zeroing in on those material financial risks, as a de novo, you don't have an earnings history to point back to. And so you have to think about building these foundations from a place of just instilling trust with your regulators, and while at the same time making sure you understand again the why for that or for your organization and why you're headed where you are. The technology part is really interesting because right now we're in an era where things are evolving at a pace that is just unprecedented. I think that's just the natural evolution of technology and the speed at which it moves. And I think it's very important that there's open dialogue with the regulators, especially on the technology piece. We have to be empathetic of the experience that they are living. One, these agencies are dramatically understaffed. Two, they are also in a position where they are getting access to new tools and new technology like artificial intelligence for the first time in their capacity. And so we've talked a lot about in our foundation building, especially as it relates to technology, thinking about the examiners as consumers of the things we're creating internally. So, whether that's run books, playbooks, policies, procedures, the audience isn't just internal teams that have to use those, it's the examiners. And so trying to kind of build that foundation with examiners as consumers of the information and the time spent with people that you're working with. I would say on the operation side of things too, this is a place where there's a lot of opportunity and openness from the regulators on automation. And so I think being really, really clear on where you've got a human in the loop, how you're testing those operational procedures, and making sure that because you're on a 3-year de novo business plan trajectory, that you have a clear idea as you're building this for what that trajectory actually looks like. It's not just an internal conversation of like, oh, by year 2, we want to get here. It's actually writing it down on paper so that when examiners come in during year 1 and say, where are you going next year? You're not thinking about that for the first time with them. A lot of this really is a big long game exercise. And I think that sometimes gets lost amongst the conversations about deregulation or conversations about the speed at which the agencies are moving. Just because they're moving more efficiently doesn't mean they care any less. Also, the statutory factors they're evaluating against are exactly the same as it was when it took them 2 years to decide these things. And so you have to build that foundation with those things in mind and be just really clear and crisp on examiners consuming your materials, how automation is being used within your enterprise, and how you see that scaling kind of on a risk basis with your customer profile and the asset size of your organization.
Amazing. Thank you so much. Okay, Carl, got through year 1. Talk us through sort of year 2, maybe year 3.
Sure. So typically at the end of year 1, the institution will be operating at a loss. But by end of year 2, the expectation, and it'll be seen in the 3-year pro forma projections, is that there will be a profit. The institution will have turned a corner, and the regulators want to see this sort of steady growth. They don't want to see rocket ship growth, but they want to see the steady growth end of year 2 going into year 3. And so what they want to see is stabilization and that steady growth. They're going to be looking, judging the de novo against the business plan benchmarks. If adjustments are needed because of change in market conditions, that should be done. Now, remember that any adjustments that are materially inconsistent with the business plan typically will need prior approval from both the chartering authority and probably the FDIC. Good to build a loan portfolio, but keeping an eye on maintaining high credit quality and maintaining strong underwriting controls. The same thing about compliance, which we've talked about. And then now you're turning the customers into sticky relationships where you want to cross-sell that deposit customer into a loan product or perhaps into a non-deposit investment product. And by now, some type of examination feedback will come back, whether it's a target exam or a full scope exam. And that is when the institution wants to respond and address any weaknesses from a supervisory perspective that might have been found. And Phil, I think if we could go to the next slide for year 3, I think I'll cover that as well. So now we've exited year 2. Now we're end of year 3, right? Coming to the end of year 3. This is where you really want to be in sound supervisory condition from the eyes of your regulator, because you want them to take off that initial 3-year de novo straitjacket, okay, or loosen the straps on the business plan so that you can do what is fully legally allowable under law and regulation. As seen there on the slides, you want to be released from this heightened supervision. You want to show sustained profitability. You want to be able to show that the institution has capital sources beyond the de novo period to support that growth, how the institution is going to grow both organically and also perhaps by acquisition, particularly in the fintech space. Founding shareholders will probably be expecting after year 3 some type of cash dividend. So something to keep an eye on there as well. And then building that reputational and brand loyalty for the institution. By now, at the end of the year 3, there should be enough of a buzz around the institution. And then last, preparing to transition to a standard supervisory cycle where, again, you're out of this de novo straitjacket and you're then going into just a regular cycle of examinations. And if it's OCC, it's typically every year and a half. If it's state charter, they typically alternate annually between the state and the FDIC, or the state and the Federal Reserve if it's a state member bank. And Phil, turn it back to you.
Yeah, no, I would say, and we're going to skip over the common pitfalls again. Juan started us there, but maybe Janet, in terms of sort of heightened supervisory expectations, right? Maybe if you could spend a moment and just talk about kind of what regulators are going to expect.
Janet, I think you're on mute.
Oh, Janet. See, I was like, okay, I apologize. I'm working on a couple of screens with the slides. I couldn't see if you were on mute, but Janet, go ahead.
Yeah, sorry about that.
You're good.
So you can see here there are heightened supervisory expectations. I appreciate all the conversations we've had so far, but once that bank is in place, things change, right? So what we really need to do is be careful with, making sure that the call reports are accurate. I mean, working at KeyBank, we had teams and teams of folks preparing call reports alone, right? So you want to make sure that from an accounting perspective, everything is aligned. There will be more frequent examinations. There will be restrictions on dividends and capital distributions. I mean, we can see the slide here. But I think, there's going to be a change. The regulators are going to allow some room for growth during that initial phase, but there will be definitely regulators walking in the door, keeping in contact with the regulatory team and the executive management, and you'll want to keep them apprised too. So if anything does pop, that you make sure that they are aware of anything that might happen.
Amazing. Thank you all very, very much for the insight. And so moving on, and I think Casey, we're going to start with you and something that we've talked about. And again, I appreciate everything you've added to the conversation, but talk to me about sort of capital adequacy. Sort of how do you think about that, and how's something that you plan for?
Yeah, most definitely. The regulators, rightfully so, have their suspicions about likelihood of success of a brand new institution. And, I think they've got some really good evidence for that. In the global financial crisis, the vast majority of failures in the first kind of wave were some of those de novos that were granted back in 2006, 2007. And so they kind of have a proof point for how much new banks can struggle during times of financial stress. You also don't have a proven business model yet. And so there's a lot on the slide here that folks can walk away with, but the things that I would kind of keep in mind if you're in this planning stage or you're about to enter it, is that these are not really negotiable, right? A lot of these are prescribed by law, and your standards are going to be higher as a de novo just because of that reasonable suspicion the regulators have about likelihood of success and what they need to do to make sure you're growing responsibly. Something that you spend time in during that build phase is really working through understanding your projections for growth and making sure that when you're setting up policies for capital adequacy and how you're going to manage that from a governance perspective, that you have various different triggers and contingency plans that are tailored to your business. If you try to take an off-the-shelf, one-size-fits-all approach to this, regulators are going to take issue with that quickly. They're going to kind of question the quality of your oversight of those things. And so there's really good best practices that are pointed out on this slide. Won't repeat them all back to you. What I will say is that if you say it in the policy you submit with the business plan, be prepared to abide by that. And make sure that you have really good board engagement. Depending on the size of your institution, you might handle some of this through management and board level committees, but it's really important as just an additional best practice is that where you are handling capital related things at a committee level, that there's the right level of detail and laddering up to the board, that the board's engaged, that the trigger points for board engagement and contingency funding are really, really clear. And I cannot overstate the importance of stress testing and making sure that is also tailored. If you're a really, really large institution, often the scenarios under which you perform the stress testing are prescribed for you, but there's a customization and tailoring that's available for smaller orgs, and it's kind of your thing to set up. But the regulators are going to judge you based on whether you understand the right type of stress testing you should be putting yourself through. I'll put a plug here too for your like pre-charter process. If you're going into your pre-filing meetings with the OCC or the FDIC or any other regulator and thinking about it kind of like a VC pitch where you're going to just sell them on how great you are, that is a mistake. You should have slides on stress testing. You should have your proposed CFO in there ready to talk about how you did stress testing against your business plan, and then also be able to talk about the things that you didn't stress test, right? Because examiners are trained to think about what's not in front of them, and ask questions and be suspicious. And so, don't take that as a bad sign. They're just trying to make sure you're ready to implement some of these best practices. And so, don't overlook the importance of stress testing. Hire people that know what it is, what it means, how to do it well, and be open to feedback from regulators on what they think is at risk for you from a capital perspective.
Carl, did you want to, in terms of capital planning, is there something you wanted to add, maybe in terms of how the way you think about it and how you speak to your clients about it?
Yeah, I think in de novo, certainly, raising the capital at the outset is a critical item. But then going forward, communicating with those shareholders and shareholder groups, what they can be expecting, particularly for de novo, and especially one that might be, fintech active or digital asset active. There should be no expectation of dividends the first 3 years, and typically dividends won't be permissible the first 3 years anyway. But it's important to manage those expectations. This is a long game, if you will, for these de novo institutions. It's about managing those expectations for shareholders, and particularly getting out of the first 3 years, teeing up those same shareholders to do a second round, a second raise of capital to put that institution in a position where it can then start to flex its powers under applicable law to engage in new business activities.
Bill,
Go ahead, Juan.
just wanted to add a couple of things. A great summary by Carl. Treasury, make sure you have a strong Treasury department with talented CFO. Obviously, the CFO and the Treasury. This is critical for anything you do. And the second other point I wanted to make is this is not just meeting a regulatory requirement. There's so many different triggers to not being well capitalized, which is likely going to be that you're also not well managed. Aside from supervisory issues, forget about expansionary activities after those 3 years, right? You're just not going to get approved. So this is more than just meeting, these little numbers, right? It really does impact the success of your new charter.
Amazing. Thank you very, very much. We're going to move on. Again, there's so much to cover. Sadly, not enough time. Juan, you have been sort of the doom and gloom guy, right? Let's jump right into let you kick off, risk management. How do you build that out? What are all the challenges that could arise if you don't do it the right way?
Yeah. And I don't want to be the doom and gloom guy, but I think every regulatory lawyer will tell you that you do a lot of firefighting. But I'm glad you gave me this option to move away from that. You really don't want to put out the fire, right? You want to make sure that you've got some good suppression systems in place, right? And that's really your lines of defense, right? I think most of us in this business know this, whether you're not a bank or not, follow them, right? I mean, this is out there. When you talk about enterprise risk management, the beautiful thing about it is that there's a lot of industry standards out there, right? There's a lot of people that have come before you and made mistakes and done things right. So just follow it. Use good law firms, right? Consulting firms, right, Janet, to help you build out some of these things. Your risk categories. If you notice something about that, hey, they're kind of tied to the camel ratings, right? And that's precisely where they're supposed to be, right? So if you do manage these risks, your ratings are going to be good, right? And that really is perhaps not as simple to implement, but it is simple in the sense that you can avoid trouble if you do things the right way. Phil, if you can go on to the next slide really quickly, I just wanted to make a comment about credit risk management, right? And I say this because out of all the areas when we talk about fintech products, always fintech lending is the one that I've always thought is the highest risk. It triggers the most, implicates the most, regulatory or regulations, right? Which means obviously you got to have policies and procedures and controls around them, so it makes it more complicated. Sound underwriting. So I wanted to touch upon that. The foundation of these things, underwriting standards, right? Very important, right? That's from both a credit risk perspective, but also a consumer compliance perspective, right? So your underwriting is critical. I mentioned concentration limits. Super important. You always, this is something that banks tend to, especially if you're a national bank, this is really important for you, Casey, as you know, right? Because the OCC is very, very tough on this, right? Make sure that those aggregate, right, borrowers and those aggregation limits in borrowers are not being violated because you didn't realize that the borrowers were affiliated companies and your concentration limits are high, and all of a sudden you get a finding that you did not expect, right? Monitoring and managing problem assets, always something that is going to be critical as part of any business plan and operational level. Reporting to the board and independent review function and things like that are all important things for that. I don't want to overemphasize credit risk in any way, Phil, but again, the firefighting skills, you're always set. Yes, that's where do they see the issues, right, during examinations, and this one always seems to be one that comes up.
I very much appreciate it, Janet. And I'm going to take you sort of to your past. You formerly led compliance for a national bank. So, what are the expectations, right? How much focus and emphasis are regulators looking for?
I think for some of these institutions that are de novo institutions, start from the beginning, put the control structures in place, because once the control structures are in place, then you're not going to have the compliance and risk issues down the road, right? So put those control structures in place when you're setting up a loan operating system, when you're setting up your processes. Think about it then. And bring in your compliance team, bring in your legal team, and make sure that is operating effectively from day one. And then you can go ahead and move forward with putting in your testing processes to make sure that everything is operating as expected or operating effectively. And then making sure that also, because the regulators are going to be looking at the reporting structures. So is the board informed of your testing processes? If there's a finding, who knows about it? You don't want to keep those hidden. And I think that is sometimes a risk with some de novo institutions. They may not want to, be scaling things and escalating things. They might want to handle it, but it's going to be really important that the folks that are, running the institution know exactly what the risks are. When they have those conversations with the regulators. You don't want the regulators finding something. You want to know, and your management team needs to know what's going on at your bank.
Casey, I'm coming back to you, and I'm going to move to slides. Apologies for the slide movement. I'm going to go back to this first slide that we had before. I often say, and I'm known for saying, not all fintech is created equal, right? Not all enterprise risk management frameworks are created equal, and some people emphasize and focus in different areas. Again, I've had a lot of experience with Juan in previous roles where we kind of kept looking at different lines of defense and what's the best way to do it, what's the best way to set up. How have you guys sort of embraced, obviously, your responsibility? I think you've made that very, very clear, but how have you looked to set it all up operationally?
Yeah, so we're following a traditional 3 lines of defense model, and we have some of that in place already. I think if a fintech entering this space tries to go, non-traditional or novel, you will face a lot of hurdles in your process. I think it's not uncommon to have like a 1.5 line, when you think about your product compliance team or other functions internally that kind of straddle that first and second line, what you're going to get a lot of pressure from the regulators on during the charter and deposit insurance review process and during your first few years is whether that second line is in fact exercising oversight and whether that third line is truly independent. I think in the fintech operating model, there's, if you're fortunate like us to have a great internal audit function already today, it might be one that relies maybe more on external audit resources than you need it to when it's actually within a bank operating model. I will emphasize the importance of building out that third line as an independent one, especially in the current regulatory environment where we're hearing, particularly from the Fed, but also from the OCC and FDIC, just an even more increased reliance on internal audit work papers and other information as the starting point for the examination process. And so if you don't have a truly independent third line, if you don't have sophisticated leadership in that function running your internal audit, you are going to be on the back foot for us. We're building on top of what we've already got. We've been fortunate to have partners that have really helped us grow and mature in that space in terms of understanding the importance of the three lines of defense. I mean, we're really trying to build a lot of discipline with establishing KPIs and KRIs that are owned at a first line level, overseen by a mature and robust second line function, and then supported and validated through that independent third line with qualified professionals. So it's been a question of like staffing and then memorializing how those lines work together, both for purposes of the examiner conversation, right? But also so that internal teams get it. This is an operating model shift for a lot of folks. And so you don't want anybody going, you know what, I don't know what my job is anymore. And so we've been spending a lot of time making sure how this kind of overlays with what we do today makes a lot of sense for the folks that are doing all the hard work of making it good.
Okay, so let's assume up until this point, everybody who's engaged in this process has done it exactly right. They've made it to where to this point. Carl, we're coming back to you. Excuse me, jumping ahead. Growth strategies for de novo banks. Carl, why don't you sort of like you've made it here? Sort of what are the next steps? How do you think about your growth?
Right. So organic growth, right, as opposed to growth by merger and acquisition. How does a de novo and then a post de novo period bank execute on that organic expansion? So first, in the classic way, is through brick and mortar branches and focusing on strategic markets. What of course we've been seeing more and more the last 20 years is Web 1.0 and Web 2.0, right? So desktop internet banking and mobile phone banking. So when you look at your cell phone, it is effectively a bank branch. Gen Z looks at that bank branch as the phone and looks at folks that are walking into bank branches to deposit a check oddly. Why are you going into a bank? So the management has to look at the market, the target market, and who are we serving, right? And so Web 2.0 digital is massive, and of course now you've got Web 3.0 with digital assets and blockchain technologies, another way to deliver financial products and services. Product diversification, okay? So when you think of loans, think of it broadly, not just consumer loans, also commercial lending, small business administration, backed loans. And Juan talked about treasury management, not just internally, but externally for clients. An institution can focus on niche markets, such as healthcare field, law firms, tech companies. Relationship banking. I mentioned earlier the importance of having a sticky relationship and cross-selling to that customer base, getting engaged in the community. And then, of course, strategic partnerships for distribution. We're going to talk about this later, bank fintech partnerships.
Is there anything, and again, Carl, again, because I know there's so much for us to cover, but did you want to spend maybe a minute more, maybe one, at M&A, lending growth and diversification, deposit growth strategies, any one of those areas you wanted to talk on a bit more specifically? Juan?
Sorry, I was on mute.
You're good.
Phil, to be honest with you, I'd love to talk about, because I know I'm shooting it's 2:54. I'd love to talk about third-party risk management for a moment.
Yeah, for
If I
sure.
may. I keep on changing things up of you, but I just think
you're good.
it is so critical because we are the American Fintech Council, right? And a lot of the companies who are filing these are fintech. So I'd like to, if possible, in the last 5 minutes, move to slide toward the last section of slides, starting in
Partnerships.
Number 7, fintech,
Yep.
Bank fintech partnerships, slide 34.
Folks, time flies when you're having fun. You just can't help it, right? You get this, this level of talent on one call. Time is going to fly by. Go ahead.
Yeah. So if you're a fintech that you've got this charter, you always remember why you needed a bank, right? And one of the reasons that why you needed a bank should have not been, because I don't have to worry about regulatory issues. You found that through third-party risk management, right? That it gets cascaded down and waterfall to you, even if no, you're not a bank. Now that you are becoming a bank, now you're directly responsible for a lot of these things. And worse yet, if you want to enter into and you become a sponsor bank, which is I think a lot what a lot of you I think out there or a lot of fintechs want to do as well. Again, whether it's sponsoring a unaffiliated fintech or an affiliated fintech, you got to worry about third party risk management now. So you're the one that's going to be cascading that down. And that's why I wanted to talk about that because it is a critical component of risk management. And Phil, if you can switch to the next slide for me. I'm not going to go over this. We know the types of fintech partnerships, lending, banking as a service, payments. I really want to touch upon the other slide, the next one, Phil. I think it's the next one. Okay, yes. Okay. There's guidance out there, right? So for those who are not banks, the banks weren't making it up, right? There's interagency guidance out there by the three federal regulators it's pretty prescriptive. One of the best, I think, pieces of guidance, I think many of us would agree, in years. It's called the Interagency Guidance on Third-Party Relationships. Learn it. You're gonna have to learn it because guess what? This doesn't even apply just for fintech partnerships. It's anyone you have a business arrangement with. And that's as broadly as it sounds, including affiliates, right? So vendors, right? Technology vendors, people that maybe you hire for something that you think this is not fintech. Doesn't matter. It's a third party, right? So you still have to worry about that. It's going to require due diligence, onboarding due diligence on a risk basis. Very important, right? So you'll see it's going to talk about critical vendors and those that are not critical, and that's going to drive a lot of the third-party risk management that you're going to have to do going forward, level of monitoring, reporting, and things like that. And as it says there in the last slide, your regulators are going to expect their supervisory expectations are going to rise with the level of risk that party poses to your new bank. Last thing, we always say this phrase: "The buck stops here," right? The buck stops at the bank. Even if this is the worst part about it, of this whole thing, even if it was not your fault, you had nothing to do with the issue, it's your fault, right? Because you entered into a relationship with a bank. So that is very important for that. Very quickly, best practices for successful partnerships. Actually, Phil, if you can go one slide before, I think this is pretty self-explanatory. I'm sorry, one slide after. The contractual part is what I wanted to talk about for a moment because the program agreement work, there you go, beautiful. Program agreement work, a lot of you have, I'm sure, experience with this, but you're going to get a lot more out of your program agreements and you're going to get it done very quickly if you focus on certain things that seem to come up in every single agreement. Service level agreements, what's the level of performance, right? Metrics and penalties. Data, always. Who owns the data? How much of that data is going to be shared? It's always an issue back and forth. Who's going to do what in terms of compliance obligations? You're a bank now, right? So you're going to have to rely on, well, you don't have to, but you will be relying on some of your partners to do some of this. So how do you allocate that contractually? Audit rights, you have the right to go in and examine them. Indemnification, who's responsible for losses and credit fraud? I laugh because I think of these fintech partners out there who were frustrated with banks will now understand what it is with their own charter, why the bank had to be the way it is. But again, I won't go through all of this, but these are some very important components.
Yeah, and Phil, can I just make one plug for affiliate transactions?
I was going to you next anyway, but go ahead.
So this is something that I think is like it's a reg that doesn't apply to you in the fintech space. But if you're not familiar with Reg W or Sections 23A and 23B of the Federal Reserve Act, which apply to all banks. And a common misconception for folks pursuing this charter is like, oh, we'll make the bank a subsidiary within our enterprise, and then it'll just do stuff for free. We'll get rid of all of our costs associated with all these other things that we run. It's not how it works. The long and the short of it, Reg W requires you to do things on market terms with affiliates within your enterprise. Got to have a lot of documentation around those things. And so as you're thinking about legal entity structure, as you're thinking about what examiners are going to expect to see from you, really strong governance on the Reg W side. The principle there is you can't treat the bank like a piggy bank. It's got to be, better off or as good off as it would be with any external partner, even when it's working within your enterprise. And so not only will the bank be expected to apply a third-party risk management program to those affiliates, but there's also an expectation under Reg W for market terms and for really good documentation and monitoring of covered transactions. And so don't sleep on Reg W. It's an important one.
Thank you. I'm going to stay with you just for one very quick second, and we only have another minute, and we're going to have to wrap up. But let me ask, sort of being a fintech native company, right? You've really invested a ton of time, energy, enthusiasm, and into sort of building sort of the muscle memory of a bank, right? And then inevitably, as Juan sort of rightfully pointed out, the reason for that is so you can ultimately serve more consumers, more small businesses, and so on. How do you envision, number one, the next steps? And then number two is, do you think that given where you came from, makes you better suited for the next steps? I'm trying to sort of, given where you came from, do you think once you've gotten through this point, you'll be able to sort of better partner, better work, better embrace innovations to serve more consumers? Or do you think sort of once you become a bank now, you're in a different spot?
So I think that where we've come from is going to help us, get to where we want to go. What we're really trying to be mindful of is building something that's going to last longer than any of us that are building it. And so we've tried to be really transparent with the FDIC, the OCC, and also the Fed in our process about where we do want to innovate. We put a lot of time and energy into like AI governance, for example, as both a component of TPRM and as a component of everything else we're doing. And we've also tried to have a lot of user research and customer conversations about what they need. We do that in partnership today with the banks we work with to make sure we're evolving those programs and adding new features that meet that. But we've also been really diligent about that and building what we want to put out there and trying to identify for the regulators. It's not just innovation for the sake of innovation. It's innovation because it's what the folks we're trying to serve want and need in order to run successful businesses and manage their personal finances. And so when you marry that customer need with the awareness of safety and soundness, I think it goes a really long way. And we're hoping it's an accelerator for us.
I love that. Casey Seifert, Deputy General Counsel over at Mercury, Janet Hale at FTI, and of course to our great friends, Carl and Juan over at Winston Taylor. I want to remind folks, Winston Taylor, who have been just tremendous partners for us. I kid you not, any one of these topics could have been a full hour. We didn't cover even a fraction of what we were hoping to, but that just means you're all committing to coming back and doing this again. Really excited to continue our partnership together. On behalf of the American Fintech Council, I just want to say thank you to everybody who joined us today and look forward to so much more together.